Please enjoy today's program and welcome the man that made all this possible, Dr. Mark Reedy. Thank you.
Thank you, Chairman. Thank you for your leadership on the Policy Advisory Board Executive Committee. Thank you all for being here, and a special thanks to our terrific corporate sponsors and our presenting sponsor, U.S. Bank, as well as the breakfast sponsors. The hotel did a great job, I think, and so we're pleased about that. You mentioned Facebook and all those things. I'll tell any of you that are using wireless, if you'd like to, the network for this hotel, we don't normally start this way, is Hilton M as in Mark, T as in Tom, G as in Gary. So if you want to hook up that way, if you're in the media in particular. I want to make a few comments before I explain the theme of this conference and also welcome and introduce our keynote speaker. In the printed programs which you have, we have listed all of the descriptions of the corporations that have been so generous in their sponsorship of the program. We also have the biographies of all the speakers and all of the moderators. So I hope somewhere along the way, maybe while I'm talking, you take time to read all that in the printed program. Please also note at the end of this program at noon, we will have a drawing for one continuing education course. It's a $450 value, so if you haven't already dropped your business card into a little glass bowl out in front, and if you go out there, please consider doing so. Traditionally, we have given out coffee mugs to our speakers and moderators, and I suspect the CEO of Fannie Mae doesn't need a coffee mug, and nor does anybody else. So instead of that, going forward, we in the Burnham-Moores Center, in the name of each speaker and moderator, provide a donation to a project here on campus at USD, I say here, but on campus at USD called the SEED Project, which each year is responsible as a class project for renovating the house of a needy or disadvantaged family in the neighborhood of the university, which is the Linda Vista area. Now let me just turn briefly to the theme of the conference. It's really one sentence long, and as I was thinking about it for this year, it was simply to shine a laser light of focus on the issues that keep all of you awake at night. And hopefully we've set up the lineup of speakers from top to bottom that can help you answer that. So let's get right to the reasons why we're here so early this morning, and I appreciate you all being here pretty much on time. To address Mike Williams, who's sitting over here for a second, I didn't know how much or how important you were to our program, Mike, until literally, my wife can attest to this. Yesterday morning, I woke up, and you wake up and sometimes you have a quick thought. It was, I wonder how big Fannie Mae's market share is. Why the hell am I thinking about that? I mean, this is the first thought of the day. That's a tough way to begin. You've all, again, in the printed program, read his extensive experience from 1991 onward on all the operations sides of Fannie Mae. And he has had a tremendous career there. Obviously now he's in the middle of a political and financial firestorm in Washington, D.C., and things are swirling around in Congress that nobody can control, so it's going to be interesting how that plays out, but I'm not going to talk about that anymore. He has worked in a wide variety of facets, again on the operational side in particular. Fannie Mae is so large, it is still obviously functioning, and it is critical. When I jokingly woke up and thought about Fannie Mae's market share, but it's still critical for one of the key elements of the recovery in America today. So I'm thrilled that he's going to, as a major player, perhaps the major player in the business, talk about it, because I really believe, and which is why we were most fortunate to get him out here, is that housing almost always leads the American economy, and I say housing includes mortgage markets, into problems or recessions, and again, out of problems or recessions. And usually it's, I don't know, a 3 to 9 month difference. So to the extent that we understand what's going to go on in housing, then the majority of you who are on the commercial real estate side of the business, along with the other speakers and what they have to tell you, will hopefully be able to figure out your own plans versus what you've heard up here and make adjustments if you need to, but this is really a learning experience for everybody. I've learned that Mike is a family man. He's certainly personable. We had time to chat today. He cares about his employees. I'm told that he works harder than any other employee in the organization, which I think is admirable. I like that in a person. He was very quick to respond to Doug Duncan's invitation that he come out here and join us. Doug is the chief economist of Fannie Mae, and he's on the Center's Policy Advisory Board Executive Committee, so he's become a real friend of the Center. I have two other quick comments. One was that I'm a University of Michigan alum in my PhD program. He is a fanatic supporter of Ohio State University, and we almost canceled this presentation, but not quite, Mike. The other thing I said to Doug, well, just give me something else on Mike. He said, well, you know, I have never, ever in my life seen him without wearing a tie. I said, okay, and I talked to Doug this morning. He said, well, it goes beyond that. He said, I've talked to his assistant, and she said, when he goes to sleep at night, he's wearing a coat and a tie. So without further ado, because he is a great guy, please join me in welcoming Mike Williams, CEO of Fannie Mae.
Well, good morning, everyone. It is great to be here with you in sunny San Diego and outside of Washington. Even if it isn't sunny, it's great to be here in San Diego. Trust me on that one. I want to thank Mark for not only the kind words he said, and I'll forget the part about Michigan, and just say, you know, how much we appreciate the partnership that we have with the center here. In fact, I want to thank Mark and the center because we were able to hire Ryan Kurth, who is one of your graduates, into our economics department, and Ryan's doing a fantastic job for Doug. So congratulations, and thank you very much to the center. Let me also thank each and every one of you for working so hard to put the real estate industry back on track. We all want an industry that is stronger and sustainable for the long term. And I believe that we are making positive steps to build a stronger foundation for housing in our country. It is a foundation built on what I call a new realism, a return to common sense lending standards, a re-examination of what constitutes sensible risk, and a long-term view of the market. Make no mistake, we have a lot of work ahead of us, and I know everyone in this room is aware of the human cost of this recent crisis on our families and our communities. We have a responsibility to get this right, and at Fannie Mae, we take our responsibility very seriously. Today, I will address what Fannie Mae is doing to help that new realism become the reality of a sustainable market. As we settle into the new year, the housing market is still facing some strong headwinds. The economic recovery has been slow, unemployment remains high, and many families are still struggling to meet their mortgage payments. We recently released an update of our survey on consumer attitudes about housing, which Doug Duncan leads that effort for us. In it, we found that Americans are more confident about the stability of home prices. Nearly 80% thought that home prices will hold steady or start to increase over the coming year. While most Americans still think that owning a home makes a great deal of sense, more sense than renting, they are less confident than they were in years past about how safe that investment is. They are also less optimistic about their personal finances than they were a year ago, and therefore they're more willing to rent for our friends in the multifamily business. In fact, more current renters plan to continue to rent rather than buy their next home. Overall, the survey demonstrates that Americans have become what I would call more realistic about home ownership right now. Turning to our expectations about the U.S. economy, we believe that it will move from a fragile recovery to a steadier expansion in 2011. We also expect slightly stronger growth in housing activity, particularly in the second half of the year. But given the many variables at work, we are only cautiously optimistic at this point. California is a case study for some of these trends. As you know, the state suffered through one of the greatest spikes and then largest declines in housing values in history, with home prices falling over 44% from their peak in 2007. Today, California has the nation's third highest foreclosure rate and leads the nation in foreclosure filings. Looking ahead, we expect further declines in housing prices this year, albeit they will be modest for both California and the rest of the country before we start to move forward and move upward. However, we believe that our host city here in San Diego will be one of the bright spots, with prices growing moderately during the course of the year. We also expect home sales across the state to grow at a moderate pace, more moderate than the rest of the nation, though. And still, challenges persist both in housing here in California and around the country. Creating solutions to these problems and challenges requires practical, effective, and long-term changes in our industry. And I want to highlight 5 of the actions that we are taking at Fannie Mae to help build a stronger housing market. First, we must keep liquidity flowing. We all know that in the financial crisis of 2008, private investors exited the market. The federal government provided substantial support to Fannie Mae and Freddie Mac, and which allowed us to keep buying mortgages, keep funds flowing, and hold down mortgage rates for a long period of time. All of this was crucial as we were facing one of the worst financial declines since the Great Depression. As the number one, coming back to Mark's point, as the number one supplier of housing funds in America, Fannie Mae has delivered nearly $1.5 trillion in mortgage liquidity since 2009. But leave aside the fact that these are large numbers, which they are, what does it mean for people? What it means is that we have worked with our lender partners to help more than 1 million families buy homes. We have helped more than 4 million families to refinance into either a more stable mortgage or a lower cost mortgage. In California, since 2009, our financing has enabled 234,000 families to be able to buy a home, and almost 750,000 families to refinance. At the peak of the housing market, Fannie Mae was 20% of the market. And now to Mark's question, today we provide over 40% of the single-family market funding and 35% of the multifamily funding in this market. At Fannie Mae, we remain true to our fundamental mission, which is enabling mortgage liquidity in all cycles, good and bad. Let me move to our second principle, which is helping distressed homeowners. Even though we've seen some strengthening in the market, and we're hopefully going to see a much better year this year than last year, millions of American homeowners are still struggling to keep their homes. Everyone loses when a family is faced with foreclosure. The cost to homeowners, to neighborhoods, to the market, and to our company is severe. So we're doing everything we can to help them. Fannie Mae has one of the largest foreclosure prevention operations in America. In 2010, we helped over 400,000 families to avoid foreclosure through modifications and loan workouts. We have also undertaken innovative approaches to outreach and borrower education. One example is something we call Know Your Options, a program designed to empower homeowners with the information they need to make good decisions for their families. These efforts to help distressed homeowners are unprecedented in scope, and they are making a difference to people like Joyce Lee of Culver City. Joyce fought for 2 years to secure a loan modification. She tried working diligently with her lender. She tried reaching out to the support of her neighborhood association, but she still could not get the help she needed. Then Joyce turned to the Mortgage Help Center in Los Angeles. She worked one-on-one with our Fannie Mae mortgage counselor, who assured Joyce that together they were going to find a solution. And it was Joyce's Christmas wish that she would secure that modification. On December 22nd, we were able to inform Joyce that her modification was approved and she could stay in her home. Joyce wrote to us to thank us and say that our Fannie Mae Help Center is an important resource for her and for all the struggling homeowners in her community. These extensive foreclosure prevention efforts are not only there to help families, they help stabilize communities, and they are helping Fannie Mae in our efforts to avoid losses, which also benefits our taxpayers. Unfortunately, though, foreclosure is still a reality in many situations. And when that is the case, we do our very best to help families transition into other housing with dignity. We're also looking to protect property values. Whether it's an initiative like First Look or HomePath.com, our team is very focused on preserving value and preserving neighborhoods. Here in California, we have sold over 40,000 properties over the last 2 years, and on average, we have retained 98% of the property's value through the efforts we have undertaken to preserve the home and preserve the neighborhood. Third, let me move to our next area, which is encouraging sustainable lending. At Fannie Mae, we are striving to help our industry address the problems of the past and position itself for a sustainable future. At Fannie Mae, we are taking efforts to strengthen lending standards to help ensure that working families can not only buy a home, but that they can stay in the home. We are emphasizing long-term fixed-rate mortgages, which is our core product, and it's a product that protects homeowners from interest rate swings in the future. We are requiring better credit quality, better documentation, and better property appraisals. We are creating tools for lenders to understand the quality of a loan before they sell it to Fannie Mae, helping the lender and Fannie Mae to reduce future risk. And we are committed to developing a better model for servicing mortgages as well. When the mortgage crisis hit, we turned to our servicers to help deal with a tidal wave of families who were facing foreclosure. But the existing servicing model provided little incentive for a different approach to dealing with these homeowners and different responsibilities. To solve this problem, we are working with our regulator, FHFA, Freddie Mac, and Ginnie Mae to develop a new servicing model, one that supports servicing non-performing loans, improves services for borrowers, and reduces financial risk for servicers. From the Loan Quality Initiative to rethinking the servicing model, we are committed to building a better system now, which will drive a new realism in housing and help us serve our industry better in the future. Our fourth principle is to continue our support for rental housing. As demographics change, demand for quality, affordable rental housing will continue to grow. According to the Harvard Joint Center for Housing Studies, the number of households in America is expected to surge over the next decade, up to 1.5 million more households per year. Immigration will be a key driver of the growth and substantially affects rental housing, because most of the households who will be entering the market will be new Americans who will tend to rent first. To help meet this need, Fannie Mae is the leading provider of capital to the rental housing market. In conjunction with our multifamily partners and housing partners, Fannie Mae has provided nearly $17 billion in debt financing for rental housing in 2010. We also continue to maintain our commitment to affordable rental housing. For example, we worked with San Diego's Housing Commission and Greystone, one of our multifamily lender partners, to provide $37 million in long-term permanent debt. This enabled the City of San Diego to preserve more than 500 rental units for low and moderate income residents. Finally, our fifth area of focus is building a better company. We are taking important steps to begin restoring America's trust in Fannie Mae. We are working to improve our overall performance. Loans acquired since 2009 now comprise over 40% of our book of business. This is a strong book of business that we expect to be profitable for the life cycle of these loans. As we continue to build this strong, profitable new book of business, our foreclosure prevention efforts help reduce losses on our legacy book of business. We are providing the market with needed liquidity, we are setting standards for sustainable lending, and we are driving operational excellence to strengthen our company's capabilities, reduce our risk, and provide responsible stewardship of the resources that we've been entrusted with. We still have work to do, but we are making measurable progress. We take our mission very seriously, and we are committed to helping our communities, our partners, and our industry to move forward to a new realism in housing. We know that the mortgage market will change in the years ahead. Our company is preparing for change, preparing to best capture future opportunities to serve the market. As policymakers consider how to reform the housing system, we expect vigorous debate from all sides of this issue. We continue to contribute insight to the reform process based on the deep expertise and experience of the outstanding people that work at Fannie Mae. But most importantly at Fannie Mae, we remain focused on delivering our immense responsibilities today and creating value for tomorrow. This is a pivotal time in housing, and we must remain focused on the challenges at hand. We can build a better housing market, one that emerges from this difficult period stronger, healthier, and better prepared for the future. Thank you, and thank you for this opportunity to address you today, and I'm happy to take your questions. Yes, sir. Let me repeat the question. There were two parts to it. The first one was the 30-year fixed rate mortgage and the mortgage interest deduction. What do I think the role for those will be in the future? I think I'm going to set the mortgage interest deduction aside for now because I think that debate is probably likely to come later. As people have seen the white paper, Treasury has issued the white paper. We are not engaging per se in terms of providing our alternatives. We're supporting policymakers as they go through this debate and making sure that as they go through the debate, they have the information and expertise that we can provide to that debate. Having said that, I think to your point, there are really 5 questions that policymakers will need to consider as they evaluate the options and decide on the market that they want in the future. And the first is your question, which is what's the role of the 30-year fixed rate prepayable mortgage in the future? And is that going to be an integral part of housing finance in the future, because that will have an impact on which option you pick. The second piece, the second question I think policymakers will need to look at is how important is it to continue to maintain that deep liquid securities market that we have for mortgage-backed securities, which has allowed us to bring investment in from other areas of the market so that we can keep interest rate low and keep funds flowing. The third question, I think, tied into that is what do we see the role of the secondary market being in the future, and do we want a secondary market that supports all markets, all customers at all times? Fourth question I think that they'll need to address is do we want to ensure, or how do we ensure that we have balanced housing policy that supports both single-family lending as well as multifamily lending? And also, what will be the role of the housing finance system in ensuring that low, moderate, and middle-income Americans have access to the same financing that upper-income Americans do? So I think those are the 5 questions. Your question is spot on. It's the first question. And as policymakers look at the options, those are the factors I think they're really going to need to look at and understand what the implications are of each of the alternatives. Thank you. Okay.
Please raise your hand if you would like to ask a question.
We'll go over here. Yes, let me repeat the question. Can I comment on the possibility of Fannie Mae being privatized? I'll go back to my answer, the first part of my answer to this gentleman's question, which is we're not engaging on providing options to the market. What we're trying to do is support policymakers as they go through this process. And I think you've seen now the Treasury's come out with their white paper. This week, Secretary Geithner was testifying in front of Congress. So I see the white paper as the beginning of the debate about how to move forward, and I think policymakers have also commented that they expect this to be a long time, right? It will take a couple years to figure out the solution and then years to transition to that answer. So what we continue to do is remain focused on how we can serve the market during this period of transition and make sure that we are building value not only for the company but for the taxpayers who have invested in the companies. And so that's where we keep our focus. So thank you. I think there's a question back in the middle there.
There you go.
It's definitely on now.
Yeah. Thank you for being here this morning. My question is in regards to the state of the lending market, specifically residential. Mm-hmm. It's my understanding that between Fannie, Freddie, FHA, and Ginnie Mae, you now account for more than 90% of the new origination market. In your opinion, why are the banks so reluctant to lend?
Well, I think in this case, I know everybody heard the question. So I think we are clearly, to your point, Fannie, Freddie, and Ginnie Mae / FHA have really been 95% of the market since 2008. The banks, and let me clarify, the banks are lending, but what they are lending is product that can be sold to each of those 3 enterprises. So I want to be clear about that. There are lending, because I'm sure we have a few banks here with us today, and we are continuing to do substantial business. So I talk about the $1.5 trillion in liquidity that we've provided to the market that has been through the banks. What you are seeing, though, and this may be the crux of your point, other private institutions are not holding assets on their balance sheet, at least not mortgage assets. And I think we're going through a period where people have been rationalizing their balance sheets as well as figuring out the new regulatory standards, trying to understand the impact of what the qualified residential mortgage will have on their balance sheet and their capital standards. And so I think what you've seen is a propensity to just use the capabilities that are available through Fannie, Freddie, and FHA to support the market. All the way in the back, I think. Good morning.
I'm Rick Gentry. I'm the CEO of the San Diego Housing Commission, and I want to thank you for your kind remarks about us a few minutes ago.
Thank you for your support.
Thank you, sir. Could you comment briefly about Fannie's thing's still on? It's still on. Could you comment briefly about Fannie's continued support of the social mission of affordable housing?
Be happy to. I think one of the pieces of, going back to the first two questions on policy and debate, one of the pieces of the debate that, at least in the run-up to the white paper, there didn't seem to be clear agreement on how this should work is how do we accomplish our affordable housing mission? That clearly was an important part of Fannie Mae's focus, and it's clearly a part of FHA's focus. But if you go back to the session that the Treasury sponsored in last August, there seemed to be a great deal of support for the 30-year fixed-rate mortgage, a great deal of support for the securities market. There seemed to be more differences of opinion about the role of the portfolios of Fannie Mae and Freddie Mac and whether they should exist or not, and then also what should be the role of the affordable housing mission within the company. We are still operating, we still have housing goals, and we as a company are still committed to our affordable housing mission. The goals that we have today are more rational than I think they were a couple of years ago, and we continue to make all the efforts that we can and should to support that market in a way that is sustainable. And so that's really where we're focused. As we've both highlighted, we've done some great work with some of our affordable lending partners in the multifamily business. The other piece of Fannie Mae's business and Freddie Mac that I don't think gets enough credit is by being in the market and providing access. 30 to 40% of our collective businesses support financing for low and moderate income Americans in this country. So just by being out there, being in all markets at all times, helping banks of all size, community banks as well as large commercial banks, we provide access which reduces the cost of funds and enables low and moderate income Americans to be able to have the same access to mortgage financing that everyone else has. And I think that's an important part of our mission. But we still have housing goals. They're more rational housing goals, and we as a company remain committed to doing our mission and doing it in a sustainable fashion. Yeah. Yes, Mark.
In terms of multifamily,
right.
Can you talk more about the Fannie Mae's internal thinking, not necessarily what you're doing, but thinking about the future of multifamily?
Yes, Mark asked the question, could I talk a little bit about the Fannie Mae's internal thinking about the multifamily business? And this is one I'm happy to take because I think the multifamily business is one of the gems in the company. It tends to be dwarfed based on size by single family, but the business that has been done, the partnerships that we have established with our multifamily lenders, I think most of you who are in the multifamily business know that we've had really one of the more innovative approaches working with our partners called delegated underwriting and servicing. That's a model that's worked very well and stood us up very well during this recent housing crisis. And what's happened in the multifamily business, clearly you look at the delinquency rates in commercial mortgage-backed securities and particularly around multifamily, and they're in the mid to upper teens. And then you look at our delinquency rates on multifamily, and we're talking about 77 basis points. So you can tell the quality of the business is strong. It's an important part of the market. It's a growth area long term, as we were just talking about, given the growth in the new families that will be coming into the market over the next decade. So I am very bullish on multifamily long term.
Hi.
Yes.
You've made a few comments about affordable housing and low and medium income housing. Well, in California, especially LA County or San Diego County, for a lot of first-time home buyers, purchasing a home isn't an option. So as an alternative, there's condos and townhomes. But with what's happened the last few years, taking downtown San Diego as an example, I feel like a lot of condo projects, because of the owner occupancy, the number of investors, there's no liquidity for a mortgage. So for the first-time home buyers who are out there trying to purchase those properties, is there any discussion about those two requirements, the delinquency ratio and the owner occupancy ratio?
Let me touch on your point, because I think it's condos in certain markets have been an area that have been challenging. We, back in, I'll call it more the mid-2000s, Fannie Mae had reduced its standard for what was required to be occupied for financing from 70% to 51%. And then as we've been reevaluating our credit standards, we went back up to the 70%. And part of that is, just dealing with the reality of we saw a lot of projects get built, and as a result of those, they were not sold, and now we've seen tremendous pressure on the people that did go into those homes, on the homeowner associations associated with those communities, and so we felt we needed to come back and ensure the success of be able to ensure the success of the project. Having said that, and we think that was the right move, we do provide the opportunity for condo projects to get a waiver. We bring a team in to look at it, evaluate it, and if we think the fundamentals are strong, we are willing to work with those institutions to reduce that 70% requirement so that you can get financing for those properties sooner. So we've done some pilots. We've actually set up a team in Florida, and we're looking to expand this to other areas of the market. California will likely be one. Yes.
Specifically on the reforming the system, you mentioned the white paper released by Treasury recently. If you had anything to say about where you think the right spot for the conforming loan limit is right now, and where you see it going in the next few years. I know that's part of the conversation, and you mentioned kind of just providing information, but if you have anything to say specifically about where you see that going in the near future.
Right. Well, I'll just deal with the practical matter, which is that the first piece of loan limits was the HERA legislation, which was passed in 2008, which actually created our new regulator, FHFA, and established the loan limits for Fannie and Freddie, 417 for regular markets and 625 for the high-cost markets. In the course of the crisis, those limits were bumped up to the 729,000 limit that we've been living with. That expires September 30th, so that requires an act of Congress to go back and extend that limit that's been in place for the high-cost markets since the crisis. So I think you have to look at the reality of whether legislation would pass and whether people would be willing to go forward with the legislation in order to extend that again. The reality is the limits that are in place and will be in place for quite a while are the ones that are established in HERA, which are the 417 and the 625. So that's what it would drop back to if Congress doesn't extend the current limits that were put in place. Yes.
See any major changes in the origination fees for mortgages? I know that there's a lot more underwriting these days. There's a lot more appraisals.
Well, Sherm, to your point, for those who didn't hear, do we see the cost of originating a mortgage go up? And clearly, we've already heard from our lending partners compared to what the costs were back in '06 and '07 to where they are now. Costs have clearly gone up. They may not, likelihood is they probably shouldn't have been as low as they were back in that time frame, but clearly lenders and lending institutions are taking it much more seriously, going through the underwriting process. There's a lot of work. I think everyone is doubling down, I'll call it, on making sure that they've got the right loan packet for the file, they're ready to go forward. I think we're in a period now where you go from being in one camp to the pendulum swinging all the way over. Hopefully we'll come back to a more balanced approach that allows us to ensure that we've got the right credit quality, but doesn't require too much cost for the consumer and the lender that would end up restricting lending.
FHA's had a lot of pressure on them to raise their insurance fees, is that correct?
Yes. The other question was FHA and their insurance fees. They've actually needed legislation to make one change. The legislation was passed last year, and they just recently announced a number of pricing changes to their premiums that will have impact on the cost of FHA mortgages. So that is a change that has been rolling into the marketplace as well. Yes, we have another question here, sir.
In light of the affordable housing mission, what is the status or future of the low-level price adjustments and the inverse market price adjustments?
Yeah, I think the question was, and it's one I do tend to hear from my lending partners as well as those in the industry, what's the future of our loan level price adjustments that we have in the marketplace? And what I can tell you is that they're in place. They will stay in place. What we've done, what we've tried to do in certain places, such as in the HARP program and our Refi Plus program, where it's advantageous to everyone, is to cap those fees so that they do not become too large. But part of what we're also trying to do is make sure that we're pricing appropriately for the risk on our business. So I don't see the loan level price adjustments going anywhere anytime soon. We have time for one more question. What are my feelings on the future of interest rates? I'm looking out for Doug Duncan. This is the great opportunity. There, he's all the way in the back. And Doug, would you like to take that one on? Microphone coming. Doug is our chief economist, so I'm always happy to defer the interest rate conversation to Doug. So,
in the interest of continued employment, you can see our forecast on the Fannie Mae website. That is what I believe, or we wouldn't put it on the Fannie Mae website. We have a modest rise in rates this year, not very far from where we are. We don't expect the Federal Reserve to raise short-term rates at least until next year, perhaps even late next year. There are significant questions about the oil price spikes and whether that will bleed through to inflation and push rates up from an inflation perspective, push nominal rates up going forward. I would say that's a risk that has entered the market significantly recently with reference to Sherm's comments opening about Facebook leading to revolution in the Mideast. So that's kind of the broad picture. Set aside the risks, modest upturn.
Last question?
Sure.
Is, with the aging of the population, what's the future of reverse mortgages?
So for those who didn't hear it, Mark just asked, and Mark always gets the right to have the last question. So, but with the aging of the population, what's the future of reverse mortgages? For a number of years, Fannie Mae, working with FHA and HUD, was a leading provider of liquidity to the HECM product, which comes out of FHA and has been an important support for the reverse mortgage market. What we've actually been able to do, Mark, is we were the only ones providing liquidity for a number of years, but over the course of the past 2 years, working with HUD and the market, we've actually been able to get other investors into the market. And so now it's really not a role that Fannie Mae needs to play in terms of providing support for that market, because there are other private investors who are very interested in that product and want to buy that product. And so now that is one place where private capital has come in and supported that market. So with that, let me say thank you all once again. I appreciate the opportunity to be here with you today, and thank you so much for your thoughtful questions and the opportunity to serve you in this market.